Thank you to the Value Reporting Foundation for inviting me to speak at this symposium. I think it's a testament to the reaction that the book Professor Jim Hawley and I wrote has engendered. Moving beyond modern portfolio theory, Investing That Matters has an ambitious goal: redefining investing, precisely because we observed that investors were increasingly addressing issues like climate change, gender diversity, mining safety, and the governance of technology, and we wanted to understand the financial reasons why. Certainly, we understood from a people and planet point of view, but this is a finance book, and it provides the first unifying theory as to why from a risk-return perspective. For 70 years, investing has been largely defined by modern portfolio theory, or MPT. When people think of MPT, they think of diversification. Harry Markowitz, the father of MPT, did not invent diversification. Miguel Cervantes beat Markowitz to the punch by about a third of a millennium when he wrote "Don't Put All Your Eggs in One Basket" in Don Quixote in 1605. But Markowitz did give us the math to make diversification effective and efficient. Make no mistake about it, MPT was a revolution. It created the demand for prepackaged diversification. This led to mutual funds, index funds, ETFs, the institutionalization of the investment marketplace. MPT has affected most of what constitutes the capital markets today. MPT's math is enabled by three theories. First is economic rationality, which means that humans are risk adverse, valuing potential opportunity and potential loss equally. But we know that's not true from a later Nobel Prize winner, behavioral finance pioneer Daniel Kahneman, who with Amos Tversky proved that humans are loss adverse, not risk adverse. In other words, there's truth to the old saying that humans as a species think that a bird in the hand is worth two in the bush. The second enabling theory is random walk, the idea that the next movement of any security is not predictable. In other words, there's no path dependency, so there's no predictability. But if we're loss adverse, as Kahneman and Tversky proved, then there is path dependency. You have to know how much you paid for a security to know if you had a loss. And so movements around the price are not random. Expand that to the market writ large, and you have the basis for charting of security prices. Other non-random predictable events include contagion events. For instance, when high-quality liquid securities are sold during crises because there's an impaired market for riskier securities, thereby spreading risk to a number of markets besides the one where the risk originated. Finally, there is the efficient market hypothesis. You'll notice the famous drawing here is updated to have a Bitcoin rather than a $20 bill. But there are stronger and weaker versions of the efficient market hypothesis. But all the versions say that ultimately the market absorbs and acts upon knowable information. EMH has been rightly criticized for decades. I'll just point out that if efficient market hypotheses were correct, there would be no arbitrage desks and investment banks and no need for insider trading laws. Together, these three enabling theories combine to create the perfect myth: easily understood, intuitive, remarkably explanative, and wrong. The three theories also serve a purpose which is both elegant and troubling. They insulate MPT's math from having to deal with the real world and all its complexities. That makes the math of MPT elegant. It works. But it does that because the math doesn't have to deal with the issues that the theories assume away. Myths have power. The theory becomes true because people believe it and act upon it, what academics call performative. For MPT, the result has been to create a self-referential investing dynamic. The world, therefore, measures investing success relative to the capital markets, not to investing's purpose or to real-world needs. So we measure whether a portfolio has beaten the S&P 500, not whether you are more or less able to retire, to buy a home, or to pay for higher education. So, for instance, if you're only down 8% in a market that overall is down 10%, you or your portfolio manager has succeeded, at least in an MPT sense. But in the real world, you still only have 92 cents on the dollar to retire on or to buy that home. The lack of concern with the real world extends to how MPT thinks about risk. To MPT, risk is only volatility, the variation in the price of a security. MPT doesn't care if the source of risk is how an individual company executes its business plan, the normal to and fro of the economy, the global financial crisis, the pandemic, or climate change. As human beings, we may care. I certainly hope we care for workers who suffer in stressed economies, for the societal fraying that comes from high levels of income inequality, for the essential unfairness of gender, racial, ethnic, and sexual orientation discrimination, for the lives lost and ruined in conflict areas, for our planet. But modern portfolio theory is in fact bloodless. For MPT, the only thing that matters is that those risks create price volatility. Now, we contend this view of investing is as somehow separate from the real world is actually contrary to most economic analyses. Economists with views as conflicting as Adam Smith, Karl Marx, Ronald Coase, Milton Friedman, and Oliver Williamson all had one thing in common. Each, in his own way, considered the linkages between the real economy, society, and the capital markets and how they evolve over time. That time is important. That is the reason that they considered it. It's so needed to account for feedback loops as people, societies, and the economy affect capital markets and as capital markets affect the real world. There are these feedback loops. By contrast, MPT defines the role of the investor as extracting the best risk-return portfolio from the extant marketplace at a point in time, rather than considering how investors can improve or degrade the market over time through their actions. The problem with that framing is that diversification works and works well on idiosyncratic risks, such as those that affect a company A versus company B, or more accurately, security A versus security B. But it doesn't have a tool to affect the overall return of the market. This is the MPT paradox. Even if you're only concerned with financial risk and return and not with people and planet, the fact is that idiosyncratic risk, the type you can diversify, only accounts for from 6 to 25% of the variability of your return. The rest, or 75 to 94% of your return, depending on which academic study you select, is the result of non-diversifiable or systematic risk in the market. MPT is silent, and through its silence asserts that systematic risk, the beta of the market, will affect your portfolio, but you can't affect it. I understand why diversification, the only tool MPT has, doesn't work on non-diversifiable risk. However, all investments have impact on the overall capital markets. Just think about some of the common phrases you hear. We're in a risk-on or risk-off market. That's the result of people's investment decisions. Or index effects, where a security performs differently if it's in a popular index, such as the S&P 500. Again, that's because of how people invest. Now, my co-author Jim Hawley and I make no pretense that we are as perceptive or intelligent as Harry Markowitz. So why can we see it and he didn't? We contend that he was blinded by the market he knew in 1952. His market was dominated by small retail investors. Think of it this way. If I walk across the room, I will have affected the gravitational relationship between the Earth and the Moon. But no one, other than perhaps an experimental astrophysicist, would care. The impact's too small to measure, and in all likelihood, someone else is probably walking in the other direction at the same time. That was the market in 1952. Many small investors doing their own things. They were all price takers. Ironically, it's not the market now, at least in part because of the dominance of MPT, leading to the institutionalization of the market through the demand for prepackaged diversified products. Other factors, such as less friction in trading, widespread computerization, and improved communications technology, also play a role. But the fact is that the slow moving, random moving, retail investor dominated markets of 1952 have been replaced by technologically advanced, interconnected, and institutionalized markets today. We should note that the issues that investors care about have also grown since 1952. A change in ethics and mores is certainly part of that, but so is the communications and technology revolution that enables us to better understand what a company does beyond what it reports in its financial statements. And our scientific knowledge has evolved. Climate change wasn't an issue for investors in 1952 because it wasn't an issue for scientists in 1952. There was no scientific consensus about it 70 years ago. One other change, and this is a major one, has affected what investors care about. As noted, the market was retail in 1952, and diversified portfolios was not the norm. If you owned the stock or bond of a particular company then, that company's financial performance was what you focused on. To the extent that an investor cared about what today are called ESG factors, it was what resembles ESG integration today. How did those factors affect the company? We call that outside-in materiality. But today, investors are diversified. We also care about what any one company is doing to the environment, social, or financial systems on which the capital markets rely, or what we call inside-out materiality. The European Union is trying to square that circle with its idea of dual materiality. Outside-in materiality means what the world does to a company, and the EU calls that financial materiality. Inside-out materiality is what the company does to the world, and the EU says that is environmental and social materiality. We actually think the EU is only halfway to understanding because of those feedback loops I mentioned earlier. The real world and the capital market interact, and the real world creates risk and opportunity, the capital markets, and vice versa. So the distinction between financial or outside-in materiality and environmental and social material or inside-out materiality is, in our opinion, a bit artificial and momentary, designed to graft outside-in materiality onto an outdated version of how investors think. For diversified owners thinking about systems-level investing, the two materialities become one through the feedback loops over time. Nonetheless, the dual materiality is certainly a major improvement compared to only considering financial outside-in materiality. Now, we've already seen that investing can affect the market, creating risk-off markets, index effects, super portfolios, and so forth. But those impacts are unintentional. The key question then is, can investors deliberately affect the risk-return characteristic of the market overall? To put it in investor speak, can we, if the entire market were a portfolio, can we affect the Sharpe ratio so that the diversification tool that MPT does provide can be applied to a better opportunity set? Yes. And that is exactly what today's investors do. To do that, they have broadened or perhaps restored the definition of investing to include more than MPT-oriented activities such as security analysis, trading, portfolio construction, and risk management. Today's investors engage the real world beyond the bits and dots on the trading screen. They lobby for better governmental policy around issues such as climate change. They encourage companies to report according to SASB and TCFD, effectively setting standards for conduct. They lobby formal standard setters, such as the IASB, to create the new ISSB. They create products and portfolios to impact issues like income inequality. They build coalitions to set guardrails around how mining and extractive industries should act so as to prevent another tailing dam disaster like the one that killed 259 people in Brazil. They press for better diversity on corporate boards. Jim and I call this the third stage of corporate governance. Phase 1 looked at corporate governance in individual companies. Phase 2 expanded to ESG, but still in individual companies. But third stage corporate governance, or beta activism as it's also known, focuses on the issues that create risk and opportunity broadly, rather than on specific companies. This, I think, is the key slide of the whole presentation. Where MPT mitigates idiosyncratic risk, beta activism or third stage corporate governance activities target non-diversifiable or systematic risk. Where MPT uses diversification, beta activism tries to mitigate risks to the environmental, social, and financial systems before those risks metastasize and become systematic and non-diversifiable in the capital markets. MPT plays out in the capital markets, beta activism plays out in the real world. And finally, whereas MPT seeks to create the best possible portfolio, beta activism seeks to improve the risk return of the market overall. Let me note one other point about beta activism. We tend to think of things which affect the market overall, for instance, market regulation, interest rates, or risk factors like climate change. Or we think about things which affect individual companies. But much beta activism takes place with an industry segment in mind. That makes sense. In the real world, many risk factors affect all companies in a particular industry similarly, and those industries affect the real world systems similarly. Let me briefly, very briefly, give 4 examples of beta activist campaigns. I'm only going to mention climate change, which is the consensus systemic risk. One can argue about scale and speed with which investors and the world are responding, but virtually everyone agrees that climate change and its related physical and transition risks is investment risk. From a people and planet, rather than a finance point of view, investors, along with governments, technology, the private sector, academia, NGOs, and ordinary people have a role to play, and we are playing it. Perhaps inevitably, there are accusations of greenwashing. Without opining on any particular set of accusations, what is interesting about the charge of greenwashing is that even to make such a charge, it has to be expected that investors will impact climate change intentionally and in the right direction. After all, if we can't do that, then we can't fake it. And over time, all those dimensions are beyond MPT. Ironically, then, accusations of greenwashing, whether or not true, are proof statements showing that the world has moved beyond MPT and believes investors can affect systemic risks that create non-diversifiable systematic risk in the capital markets. As the COVID-19 pandemic has reminded us, links between global health, the economy, and racial and economic inequality are deep, wide, and persistent. I should note that pandemics from the plague onward have violently reshaped societies for millennia. Newton was under the apple tree discovering gravity because he was back home to avoid the plague which was ravishing Cambridge. There were predictions of a coronavirus-based outbreak at least as far back as 2007. They were uncanny in their precision, even citing the suspected cause of the 2020 pandemic, the combination of coronaviruses in bats and the nature of southern Chinese wet markets where live mammals are sold. So what might be the next preventable surprise to global health? One possibility is antimicrobial resistance, the increasing ability of bacteria to evolve, to become resistant to standard and even to some advanced medical treatments. The numbers are gobsmacking. Without intervention, Antimicrobial resistant bacteria are predicted to kill some 10 million people and drain some $100 trillion from the global economy by 2050. This isn't some dystopian science fiction fantasy. Drug resistant bacteria are already blamed for 50,000 deaths a year in just Europe and the US. India manufactures much of the world's antibiotics. However, upon visiting the manufacturing areas in India, Nordea, the largest Nordic banking group, observed that unregulated antibacterial effluent was a potent breeding ground for these superbugs. Nordea presented its investigations to the Pharmaceutical Supply Chain Initiative and Industry Association. Less than 4 years later, the Indian government proposed new legislation limiting the amount of antibiotic effluent that can be released. Here in the United States, the shareholder commons filed a shareholder resolution with Yum Brands, the parent company of KFC, Pizza Hut, and Taco Bell on this issue, because use of antibiotics in the food chain is an issue. Yum has now agreed to disclose its findings regarding how antibiotic use in animal husbandry threatens global health and well-being, and secondly, to discuss an optimal global scenario for the food industry to eliminate or internalize AMR costs. In other words, they are going to look at the impact on the environmental system, not just on their company. In the interest of full disclosure, I'm on the board of the shareholder commons, but I joined after this initiative was created, so it really is a disclosure, not a humble brag to gain credit. Let's move on to gender diversity, again well known, and so I'll be brief. However, any excuse to see Fearless Girl, even a slide photo, is a good one. The young woman, cast in bronze, just 4 feet 2 inches high, with arms akimbo and hands on hips, has inspired television reports and t-shirts, essays, and internet memes. Fearless Girl was commissioned by State Street Global Advisors as part of its campaign to increase gender diversity in corporate boardrooms and executive suites. Gender diversity has been an issue for numerous other firms. The 30% Coalition was founded in 2011 to advocate for boardroom diversity and boasts investors with some $6 trillion in asset under management. Legal in General, the largest investor in the UK, votes against the boards of all large UK companies which have less than 25% gender diversity on the boards. Many other asset management firms have similar policies, and even the IPO market is starting to understand. In 2019, only one major U.S. corporation went public with an all-male board. In the 3 preceding years, about half had. Goldman Sachs now will not serve as a lead underwriter for a company unless its IPO board has at least 2 women. This attempt at private sector standard setting by finance firms is working, if slower than we would like. As recently as 2012, 1 out of every 8 boards at the S&P 500 companies was all male. By 2019, that number was 0. A recent academic paper tries to understand the relative impacts of the Me Too movement, the California law mandating gender diversity at public companies headquartered in that state, and investor pressure. It finds that investor pressure, beginning after State Street began its campaign, was responsible for companies appointing 2.5 times as many female directors in 2019 as they did in 2016. Galvanized by the 2019 collapse of a tailing dam in a mine in Brazil that killed 259 people, an investor coalition with an aggregate $13 trillion under management formed the Investor Mining and Tailings Safety Initiative. The investor coalition midwifed new safety and disclosure standards in just 2 years around what had been a chronic recurring problem. There had actually been mining collapses roughly once every 2 months. The investors created 2 major initiatives. First, they advocated for, quote, a new independent and publicly accessible international standard for tailings dams based upon the consequences of failure, end quote, and the resultant review and standard-setting initiative co-convened by the Principles for Responsible Investing, the United Nations Environmental Program, and the International Council on Minings and Metals issued the Global Industry Standard on Tailings Management in 2020. Second, The coalition tackled the lack of transparency around tailings and mining byproduct storage. For example, there was no database or inventory of all the dams globally. They're generally on private property, often near indigenous populations in developing countries. About two-thirds of the industry has now fully and publicly disclosed this information. I cite those four quick examples to illustrate that whereas MPT provides risk control through diversification of idiosyncratic risk in the capital markets, systems-level investors mitigate systemic risks by intervening in the real world before those risks turn into the non-diversifiable risks that affect the capital markets. This is the finance reason why investors have become ESG advocates. Yes, we care about people and planet, but we also act because combating climate change, unsafe extractive industries, or the growth of antibacterial resistant superbugs in the food and healthcare segments are sequential manifestations of our trying to improve the overall market's risk-return character. We're trying to get the market to re-rate by reducing risk we cannot diversify away from. Today, there are more than 100 such risk mitigation campaigns, which we call beta activist campaigns, both because they target the broad market rather than individual companies, and to distinguish them from the type of activism practiced by Carl Icahn or Nelson Peltz. These activist campaigns often involve collaborations of multiple investors and often other stakeholders. When Jim and I first thought about writing Moving Beyond Modern Portfolio Theory, we were going to profile all the beta activist campaigns. But in the 6 years since we started writing academic papers about this phenomenon, the number of beta activist campaigns has exploded. There are more than 100 today. I also note that major global investor groups have endorsed the systems level approach. For example, PRI's Stewardship 2.0 is based on investors forming coalitions, often with civil society and governments, to address system risk. And in the UK, the FRC's Stewardship 2020 framework specifically asks what an investor has done to protect the financial system. So, does any of this actually help improve the risk return of the overall market? Remember, that's the finance theory rationale. Yes, it does. Quantification is difficult, but we do have a few data points from which we can make an educated guess. In 2014, the New York City pension funds, frustrated by the inability of American shareholders to directly nominate corporate board members, began the Boardroom Access Project. The Securities Exchange Commission had tried to allow direct nominations through a process called proxy access in 2010, but a lawsuit overturned the rule. Proxy access means that a specified number of shareowners could put forth their own nominees to stand for election at the board of a public company. Now, the court that disallowed the SEC rule did leave a faint glimmer of hope. Shareholders of each individual company could, if they so wished, adopt the proxy access rule by majority vote at each specific company, or for those security lawyers viewing this, by private ordering. However, making that change on a company-by-company basis is expensive and cumbersome. As of 2014, only 6 American companies featured proxy access. The New York City funds attempted to establish proxy access as a new market standard by filing resolutions to mandate it at 75 companies. Interestingly, those companies were chosen because they were exposed to various other known risks, both systemic, 33 were in the systemic, 33 were in carbon-intensive industries, and 24 had little or no gender, racial, or ethnic diversity on the board. New York City's proxy access campaign has been a huge success. Today, proxy access is something of a de facto market standard, at least among large capitalization U.S. public companies. As of July 2019, less than 5 years after the 2014 Boardroom Accountability Project announcement, more than 600 public companies feature proxy access, up from just 6. More than 70% of the S&P 500 feature proxy access. Now, the unique circumstances around proxy access, an SEC rule, the courts overturning it, and then the campaign created a natural experiment. The Boardroom Accountability Project announcement caused an excess return in the shares of those 75 targeted companies of 53 basis points. The city owned roughly $5 billion of stock in those companies, so it profited to the tune of $26.6 million. Were that re-rating applied to the entire U.S. equity market at the time of the announcement, it would have added $132 billion to the U.S. equity markets. There are data points around the other issues as well. For instance, a 2018 McKinsey study which looks at how gender diversity correlates to profitability, the impacts of the sequential mining disasters on market capitalization, the Wellcome Trust quantification of the potential cost of antibacterial resistant bacteria. In total, Jim and I looked at more than 100 academic and practitioner studies of various ESG factors and their impacts on valuation, profitability, and other performance metrics. We estimate that third-stage corporate governance efforts by investors to reduce systemic risk have increased global public market values by some 2 to 5%, or $2 to $5 trillion. Now, I am the first to caveat that number and note that it's an estimate rather than a financial calculation. However, in the end, the number's not the point. As my friend and the co-author of my previous 2 books, Scottish social entrepreneur David Pitt Watson notes, without investors enforcing accountability on those to whom power is entrusted, capital markets will fail. In other words, as eye-popping as that $5 trillion figure is, the value of investors beginning to understand their stewardship obligations to the real economy, to the societal and the environmental systems is even greater. That is what moving beyond modern portfolio theory, investing that matters, is all about. I hope this was informative. I thank you for listening, and I again thank the Values Reporting Foundation for inviting me to speak today.